Today I want to talk about the Inflation Reduction Act that was just signed into law on August 16th, okay? This was a big one. You've heard a lot of news on it. I'll go into some of it, some of the revenue generating sides of this bill, but I'm not going to go into everything. The idea behind this bill is that it's going to reduce the deficit by about $300 billion. And while doing that, it will invest in domestic energy production and manufacturing and will reduce carbon emissions by 40% by the year 2030. The bill will also allow Medicare to negotiate prescription drug prices and expand the Affordable Care Act by 3 years. So we've got the table up so you can see it. Total revenue that's expected to be raised is about $737 billion. $222 billion of this is coming from the 15% corporate minimum tax. $265 billion of this is coming from prescription drug pricing reform, and $124 billion is coming from IRS tax enforcement. That's one that I'm going to cover in a minute. $74 billion is coming from 1% stock buybacks fees. And then lastly, they're expecting to raise $52 billion from the extension of the loss limitation. I'm only going to address a couple of these items. I don't want to get into all the details. You've probably seen enough in the news. So I'm going to talk about the IRS enforcement that's expected to raise $124 billion, and I'm going to talk about the extension of the loss limitation provisions that it's expected to raise $52 billion. Let's start with the IRS enforcement. If you look at what the IRS makeup is currently, there's approximately 80,000 employees, I think a little bit less, and that's dwindled over the last decade as there's been budget cuts every year. If you've talked to your CPA and they've ever talked about the IRS, you probably know that they're extremely frustrated with the IRS right now, and you as a taxpayer are extremely frustrated. They're super behind, so they're really not in a great position. They don't even answer the phone half the time. You call them and you basically just get a recording that says, hey, we have too many callers right now. Click. They've been understaffed for a long time. But the idea behind this is that we give the IRS some money. So in this case, I think it was $80 billion that they're giving the IRS to hire employees, and they're expected to hire about 87,000 employees over the next 10 years. Well, if you think about it, it sounds like a lot because, okay, if we currently have about 80,000 and we're going to hire 87,000, aren't we doubling the IRS enforcement? Well, not exactly, because one of the big problems that the IRS has had or will have over the next 10 years is there's also a lot of them that are going to retire. They're estimating somewhere between 35,000 and 50,000 of the employees are going to retire over the next 10 years. That means, let's just say 50,000 retire and we actually hire 87,000. That means your net gain is only 37,000 over 10 years. And again, that increase is coming from a place where we're already very understaffed. It's not like they're on top of things. And I think in the first year, it's just over 5,000 people they're expected to hire. If you look at that, there's only 5,000 out of the 87,000 they're supposed to hire in 10 years. They're really only increasing their employment force by somewhere around 1%. I think what we're going to see is the IRS has been investing a lot more in some of their systems and information technology. In theory, they'll need less employees to do the audits because most of them are correspondence audits. But I think they're so far behind and there's just so much volume with all the tax code changes recently and all the backlog of notices and audits that have been going on that I'm not sure there's going to be much of an increase. Not only that, but even if audit rates did double from hiring the new employees, it's really not that much of an effect because right now the audit rates are so slow. If you look at it over all the returns from a 2018 report, there's only 0.5% that actually gets pulled for audit. And the state tax returns get audited a lot more often because you're generally dealing with wealthier people, bigger dollar amounts, somewhere where it's more effective for the IRS to put someone in there, an IRS agent, audit it, see if they can drive some revenue. So they're targeting those returns, and your chance of being audited if you're below $10 million of income, fairly low still. And when they hire employees and they do more audits, they're going to still try and target the places where they think they're going to be most effective. So we may just see the audit rate on the higher income individuals and gift returns and things increase. and not necessarily those for average American taxpayers. Next, I want to talk about the loss limitation extension, because this is a really important one that will affect a lot of middle income and higher income taxpayers. So I covered this in one of my previous videos, but the loss limitation, or the excess business loss as it's commonly referred, is when you have a loss from a trade or business. It can only offset up to $540,000 of other income for a married filing joint tax return, or $270,000 for a single filing taxpayer. So I want to give you a real example of, let's say you have a married couple, the wife has a really good job, she's earning a W-2 income, and she makes $750,000 a year. The husband is a real estate professional, and he's acquired a large property, and he wants to do a cost segregation study because he's been watching my videos and he knows that this is a great strategy. So he does the cost segregation study and generates $1 million loss. And because that real estate is his trade or business, that loss would be deductible, except that we now have the excess business loss limitation rule. So because they're married filing joint, only offset $540,000 of their income. So if his wife has wages of $750,000, but he can only offset $540,000 with that from his cost segregation study loss, that means that there's still $210,000 that they're being taxed on as a couple, even though the actual loss that they have, if you look at everything together, $750,000 of wages, $1 million of tax loss from the real estate, that's a $250,000 loss, but because of this excess business loss limitation, they're being taxed as if they had earned $210,000 that year. So that remaining amount that was not deductible will carry over to the next year, but ideally you'd like to use it all that year because you really didn't have any income. So this is really important, and what they've done with the Inflation Reduction Act is they've extended this limitation by 2 years from 2026 through 2028. So this is going to have an effect. Now, I will say that the effect will probably be reduced slightly, because a lot of the ways that businesses are getting large deductions right now is this 100% bonus depreciation. Essentially, a quick overview is that right now through the end of 2022, if you buy a qualifying asset, you can write off 100% of it instead of having to depreciate it or only take partial deductions for that expenditure over many years. So it's super beneficial, and so this applies to real estate. So I hope that helps. These are just some of the major changes that may impact taxpayers, but check out my other video that'll be coming out soon, where I'm going to talk about some of the tax credits that are available on certain vehicles, or some of the other solar credits that are going to be available, because it might be useful to you.